Welcome to the Skilled MBA Finance Case Study Series. In this edition, we examine Dax Water Tech, a global leader in desalination technology, as it prepares for its next phase of growth. With rising global water scarcity and rapid technological advancements, the market offers unprecedented opportunities. To capitalize on this momentum, Dax must carefully evaluate its capital structure. Should it pursue equity, debt, or a hybrid strategy to finance expansion? The right decision will determine its ability to scale efficiently, maintain financial stability, and retain market leadership in a highly competitive sector. This case highlights the critical role of strategic capital planning in driving sustainable growth. Dax Water Tech Industries Private Limited is a leader in desalination technology, specializing in high-performance industrial systems. With a strong market presence and global operations, the company boasts proprietary technology offering significant competitive advantages. Supported by a skilled engineering team, Dax Water Tech is expanding its client base across multiple continents. Dax Water Tech Industries Private Limited is a leader in desalination technology, specializing in high-performance industrial systems. With a global presence and proprietary technology, Dax holds significant competitive advantages. Supported by a strong engineering team, the company serves a growing client base across multiple continents, reinforcing its established market position. The surge in global water scarcity has driven unprecedented demand for Dax's desalination systems, especially in arid regions and industrial sectors. However, current facilities are at full capacity, causing bottlenecks and extended delivery times. With emerging competitors, scaling operations is crucial to secure market position and meet this growing demand. To meet the 200 million rupee capital requirement, the plan includes 85 million rupees for a new automated manufacturing facility, 65 million rupees for precision machinery, 30 million rupees for hiring engineers and technicians, and 20 million rupees for logistics upgrades. CFO Amol Paranjpe is tasked with determining the optimal financing structure for this expansion. Exploring three financing alternatives. Bank loans offer fixed repayment schedules from institutional lenders. Long-term bonds involve issuing debt securities to a broad investor base in capital markets. Venture equity entails private equity investment from venture capital firms, exchanging capital for an ownership stake. Each option presents unique benefits and challenges for strategic expansion. Bank loans offer a lower cost of capital, with interest rates between 10 to 12%, no ownership dilution, and tax-deductible interest. However, they come with rigid repayment schedules, increased debt-to-equity ratios, and collateral requirements. Best suited for companies with predictable cash flows, prioritizing control. Long-term bonds offer fixed interest rates between 11 to 13%, appealing to companies seeking stable financing without ownership dilution. They provide access to a broader investor base and flexible terms. However, they come with higher issuance costs, compliance requirements, and dependency on credit ratings, impacting cost and accessibility. Ideal for firms with strong financial credibility. Venture equity offers no repayment burden and provides strategic guidance, industry connections, and potential for future funding. However, it involves equity dilution, potential governance changes, and a high cost of capital. It's ideal for companies prioritizing growth flexibility and strategic partnerships, despite the risk of strategic disagreements and exit pressure within 5 to 7 years. Comparing financial options, bank loans offer a 10 to 12% cost of capital with moderate risk and no control impact, but low repayment flexibility. Long-term bonds have an 11 to 13% cost, high risk, and medium flexibility. Venture equity, with a 20 to 25% cost, involves low risk but significant control impact and high repayment flexibility, Align repayment obligations with the projected cash flow timeline from expansion. Balance operational autonomy against growth acceleration potential with partners. Ensure financial flexibility to adapt as business conditions evolve. Assess the company's capacity to manage fixed obligations during market fluctuations, considering risk tolerance. Dax could adopt a hybrid financing strategy. 100 million rupees via term loans for equipment, 50 million rupees from a strategic venture partner for expertise, and 50 million rupees from internal reserves. This approach balances capital diversity, limits debt, and minimizes equity dilution, ensuring financial stability and strategic growth. Strategic alignment is crucial for Dax Water Tech's market leadership in desalination. Evaluating risk, each financing option impacts resilience against market downturns. Scalability is key. The optimal capital structure should support expansion beyond 200 million rupees. Chief Financial Officer Amol Paranjpe must optimize the weighted average cost of capital, balancing risk and financial efficiency. Applying Modigliani-Miller propositions and trade-off theory helps evaluate the optimal debt-equity mix. Quantifying financial flexibility's value is crucial during rapid expansion. Assessing financing choices' impact on stakeholders, including shareholders, employees, and customers, is essential. Balancing growth potential with strategic control is vital during critical expansion phases. Thank you for watching the Skilled MBA Finance Case Study series. Skilled MBA provides in-depth finance education and case studies, ideal for professionals and students seeking to enhance their understanding of financial strategies. With resources like Modigliani-Miller propositions and trade-off theory applications, learners can evaluate optimal debt-equity mixes and assess stakeholder impacts effectively. For more insights, contact Skilled MBA at support@skilledmba.com or visit https://skilledmba.com.